fuel-propelled vehicles to either electric or hybrid models, Kenya should pursue her oil exploration and commercial production. This is according to Charles Wanguhu, the coordinator of the platform, Kenya Platform on Oil and Gas, who believes that there would be enough demand for petroleum products in Kenya and the region to sustain production. Well, I had a discussion with Charles Wanguhu about this and other issues in the oil and gas sector, and this is how the conversation went down. Now, Kenya has a dream of joining ranks with countries that produce crude oil. But is Kenya's dream and quest for black gold viable and sustainable in the long run? Joining us this conversation this evening is none other than the coordinator of Kenya Civil Society Platform on Oil and Gas, none other than Charles Wanguhu. Welcome.
Yeah, so we had the early oil pilot scheme, which finally ended last year, I believe in June, having successfully shipped out one shipment, I think of about 220,000 barrels of oil. And then so consequently after that, there's been a bit of a slowdown. I mean, of course, COVID has had an impact on that. But also, if you remember, last year, Tullow and his partners actually put in what they called a force majeure notice, which basically, sort of they said, due to natural circumstances, they were unable to continue. This was subsequently lifted in September, and their contract was extended since then up to now, December 2021.
That being the case, Tullow, the British oil explorer, has until December 31st, 2021 to present a comprehensive investment plan in oil production in Turkana, or risk actually losing that concession in the two oil fields. So do you think it will meet the deadline?
It's a bit of a tricky one because consequently the international crude oil prices have recovered. So now, because the international crude oil prices have recovered, there's a possibility that we might see them either being able to access the funding to actually push on the project, or being bought out by a player who feels that now the oil is more attractive due to the increase in crude prices. But at the same time, I think there's a challenge in terms of currently there's not much activity happening on the ground. So apart from the environmental impact assessment, there's not much activity happening in Turkana. And so whether they'll be able to finish everything, because those are significant things that are remaining before they can actually make that decision. This includes land access, finalization of the pipeline environmental impact assessment, for example. So there's still a few things pending. And so unless these things are finalized within sort of the next few months, it's difficult to beat the deadline.
But Tullow has been at this game in Kenya for the last 9 years, so to speak. And that is when they discovered, the oil deposits in Lokichar. Yeah. And we're yet to get to where we're supposed to, that is develop the field for commercial production. From where you sit, what has, might have led to this delay?
Yeah, so I mean, they discovered it in 2012. And so, but what you have to look at is also Uganda discovered it much earlier. And even they haven't gotten to production yet. So it takes time, but I feel like one of the challenges has been, there's been some significant distractions, for example. So the early oil pilot scheme, the idea of trucking the oil from Turkana to Mombasa, basically derailed a lot of the planning for the bigger project. So basically, it took time to plan how to truck, how to get the agreements on board until the final sort of shipment. And then we've also had other setbacks, including the international dynamics. So we discovered it in 2012. The height of
the firm has commenced the four-well exploration.
At some point, it was almost at $100. Now we've gone back down, at some point even $20, right? So that's been a huge shift in terms of that, and it has an impact on the project. So there's been some significant setbacks, and the most recent one obviously is COVID and the collapse of the oil price again.
The company annual report for December 2020 indicated that they have written off 46.8 billion shillings in exploration costs. So from an investor point of view, let's say, for example, Tullow doesn't go the long way. Yeah. An investor eyeing, oil production in Kenya, would it be a commercially
viable investment and, sustainable in the long run, given the experience that the British oil explorer Tullow is dealing with right now?
There's two things that determine viability. One is the level of reserves. I think Kenya has just under 500 million barrels of oil. If you compare with Uganda's 1.2 billion barrels of oil, so that makes a huge difference. But that is also linked to the international price. So when the price is high, as the price has been going high recently, it makes the project more viable. And that's why I indicated even earlier that there's a possibility that you'd get another investor who might be more interested or who has the current funds to actually take this project towards
financial muscle coming in regard to that issue. There's been a shift to renewable energy. People are moving away from fossil fuels.
Yes.
Is this going to change the dynamics? How is it going to impact on us as Kenya, who is still lagging behind, so to speak, when it comes to crude oil production?
Yes, so we have a challenge. We have to basically get our oil and get it to market before the huge shift globally. But what you have to remember also is that nationally, we're still way behind. I think last time we looked at 2018 data, we had less than 1,000 electric vehicles in Kenya, right? There's been some shift in terms of smaller vehicles, for example, I think motorbikes and that kind of thing, in terms of trying to get an increment on that. But we are still at very low levels. So in terms of Kenya, we will be using oil for the foreseeable future, and it's the same with Uganda and in the region. So there is still an opportunity there in terms of if we manage to get our oil towards production, that there will still be market. If it's not international, then at least regionally.
Now, let's talk about global oil demands and impact on pricing, and then looking at the current situation we all find ourselves in, the issue of COVID. What did you say about the future? Let's say next 6 months.
The next 6 months, what we anticipate happening is two things. Firstly, as the rate of vaccination goes up, a lot of countries will again reopen. So you will see an increased demand in oil. And because a lot of the production had stopped in some instances, we might reach a point where there might be a bit of a shortage. And that will lead to an increase in the price of oil. So that's what we are seeing in the short term. As countries continue opening up, as they increase the vaccination rates, that you'll have this short-term demand. And then after that, you'll expect that there'll be oversupply again, and the price will go down. So we're likely to see sort of a settling out of the price more towards the end of the year.
We had a review of the law to have the regulator, EPRA, just try and cushion Kenyans from high fuel costs. But since January, looking at the data and statistics, fuel prices have been on an upward trajectory. Yeah. And Kenyans are crying, because since it affects a majority of, very many basics here, from transport to even our ability to buy. Has the regulator, or rather has that particular law, met its objective?
So I don't want to appear to be sympathizing with the regulator, especially as Kenyans are currently, the regulator is not the most popular regulator in the country at the moment. But what you have to remember is that EPRA is given the formula, and the formula is within regulation and law. And so they are just, their role at the moment is just to make the calculation based on the landed costs of fuel, and ensure that, and again follow up that retailers are not selling beyond the recommended maximum retail prices. And so that's their role. Their role is protect us from private sector, going way and beyond in terms of their pricing. And that was the role of the law initially put in place. But now, this is what happened last year, and I guess this is something that we raised last year, but it didn't really capture, Kenyans as much. What happened was that as the price of crude went down due to COVID, it hit lows of almost $20. The price was never translated to the Kenyan consumer. Yeah. What happened is that the VAT was increased, the petroleum development was increased, so that basically the Kenyans never benefited from the low price, because the price would have gone down to as low as 60 shillings, for example, at the height of the collapse of the global crude price. But because taxes stepped in, and taxes became more than 50 to 60%. So now that we are seeing the international price going up, that's when we are seeing the impacts of that change in policy. But this policy happened last year. It's just that people didn't really catch it because, again, they were not seeing the immediate impact.
So, Charles,
impact.
Can then, if we are to get Kenyans to access or rather, buy fuel at affordable prices, are you then saying that government can waive the taxes that it gets? Because if it increased it to over 50%, can we bring it down?
Yes, I think, and we can start, the easiest one is just to remove the petroleum development levy. And that was increased last year from 40 cents to 5 shillings and 40 cents. So already, if you look at the current price of about 122, that's 5 shillings off. It'd be already down to 117 around there just from that. And that's an easy tax policy that can easily be changed. And that will have an impact on Kenyans. Because what we've seen, over the between February 2020 and February 2021, transport cost has been the highest. There's been the highest increment. If you look at across the board, I think it's been about 20% increment. So somebody who was paying 100 shillings, for example, is paying almost 120 now, 130, because again, the COVID regulations came in place. So the cost of transport has increased dramatically. And so I believe that it's time that government cushioned Kenyans from an increment in the fuel price. Yeah.
There have been those who have been of the opinion that, we should leave, the fuel prices to, open to the market demands. Yeah. What would that mean for Kenyans?
I'm not in agreement with that. Because the reason we put in this law was that the private sector was actually acting as a cartel, right? So they'd set the prices on a Thursday afternoon, and then all across, instead of a healthy competition between them, you'd go to all the stations, and all the stations would have the same price. So government stepped in. But then government now has stepped in, and the impact is that instead of the private sector being the ones who are gouging the price, it's actually government that is stepping in and collecting quite a huge amount in taxes and levies.
Now that we've already established that government indeed can intervene in as far as fuel prices are concerned, with the current situation, I think it finds itself in a catch-22 situation. And I'm talking about, the loan from IMF and the consequent proposal there to, increase the VAT on fuel prices. Where does this leave Wanguhu?
I think there was a proposal in 2013 again to increase VAT. There was significant public uproar about it. The catch situation is, of course, that IMF is the one who's ensuring the governments to expand the net. But at the moment, the net is as wide as it can come. I think any increment on VAT would be an undue burden on Wanguhu. And will also not be sustainable, because you have to reach a point where tax doesn't make any sense anymore, and you're already seeing we're reaching that level. So when you're saying people are crossing over to Uganda to buy fuel because fuel is cheaper in Uganda or Tanzania, we're reaching that point where now again the effort that will take to actually regulate an increment will not make sense in the long term, because basically EPRA would have to increase its capacity by X amount to ensure that retailers are not again diverting fuel that's supposed to go to the regions. So I think at the moment government is in a straitjacket, but fuel is not the option that it'll have to go to. It has to look at other avenues for raising taxes, including it'll have to look at the civil service and see where cuts are going to be made there.
So if you're given an opportunity to actually make a recommendation and see it through, to tackle this issue of fuel prices, how would you go about it, Charles?
As indicated before, I would first remove the fuel development levy. It serves no purpose at the moment, so that's already a 5% reduction in that. I'd reduce the VAT on the price of fuel as well. And again, just sort of reviewing all the levies that go into fuel, I think that to me would be the bigger impact. And then we have to again look at the retailer margins, because again, it's too attractive at the moment for the retailers. You're not seeing any retailers complaining, because normally every time you implement price control, the first people who would make noise would be the private sector. They'd say, oh, you're stifling competition. But they're awfully silenced, because at the moment they have their margin, I think about 12 shillings, which they're comfortable with. And that reduces competition. So they also don't even have to, for example, advertise as much, because there's no real competition in the sector. So at the moment, I think those are the things I would do. I'd work on the petroleum development levy. levy, as well as the retailers' margins and the VAT.
Now, looking at the retailers' margin, they've said around 12 shillings there. So if we were to cut this 4.28, that's 4 shillings and 28 cents to around 2.3, would this particular imputation of oil, or rather crude, be as attractive, or will we have lost a niche there?
We will. I think we will still be okay. I mean, the Kenyan market is one of the bigger markets in the region, even in terms of the amount of fuel that we spend per day. Regionally, I think we are still the highest compared to Uganda or Tanzania. And so it's still an attractive market, and the retailers would still stay. And if you remember, we started off, I think the retailer margin was around 6 shillings. This has gone up over a period of time. And so therefore, I think if we are all to tighten our belts, I think everyone has to tighten our belts, including the corporate sector.
So government can also correct this?
Yes, I believe government can correct this. I do not believe that you should remove the price control mechanism, but government can step in and cushion Kenyans from the impacts.
Now let's move away from the commodity and look at infrastructure within the region. Just last week, we saw Suluhu Hassan, the 6th president of the Republic of Tanzania, make her first official visit to Uganda there, and inking that particular deal for the East African crude oil project there. But what does this mean, for the race on crude oil production, especially within the larger East African bloc? What does this mean for Kenya?
I think on a personal level, I must say, I was a bit disappointed at that announcement. I always maintained hope that at some point Kenya and Uganda would reach an agreement on the pipeline, because if that happened, then it makes both projects way more attractive. So you bring Uganda's 1.2 billion barrels, Kenya's 500 million or 600 million barrels. So all of a sudden you're almost hitting 2 billion barrels of oil, which makes the project more attractive. And then you're sharing costs, for example, in terms of the pipeline. So both countries, it was a win-win for both countries. And so I held on hope that at some point that would still happen. So I mean, kudos to Tanzania. They will be able to open a whole new transport corridor, because now this route from Uganda to Tanga would make Uganda also very more attractive to a lot of the other countries in the region, including Rwanda, Burundi, and DRC. So it was a big loss for the Kenyans, and Kenya's future as sort of the gateway to the region. And so that impact remains there. And so now we're left with LAPSET. And you start looking at LAPSET and saying, okay, what's the next sort of attractive play that Kenya has? So attracting South Sudan, of course, but again, it's a region in turmoil at the moment. So you look at all the partners who would benefit from LAPSET. Ethiopia is undergoing some transition. South Sudan has been suffering from its transition itself. And so it will take some time before we actually recalibrate and benefit from some of the investments that we're putting in at the moment.
From where you sit then, does this then affect, Kenya's trade, and as far as trade is concerned? I mean, Uganda and Kenya are concerned, because if you look at investment and trade, Uganda is one of our, key exporters,
I think
source markets actually.
I think Kenya has to really look its corridors now and start addressing some of the issues that the regional countries have been complaining for a long time. So, for example, the issues around corruption on the road, the issues, for example, around the way bridges, the infrastructure that's there for the truckers and that kind of thing. So they have to relook and really try and see how can they optimize that so that we do not lose out in the region. And I think that should be a huge priority for Kenya at the moment.
Now, what lessons can Kenya learn in as far as crude oil production is concerned from other states, especially African states that have gone ahead in as far as crude oil production is concerned?
I think a good country to learn from would be Ghana. So Ghana made a discovery and managed to get it onto market pretty quickly. Although it made also some mistakes in terms of borrowing. So, I mean, in terms of learning there, I think Ghana would be at the forefront of Kenya's learning in terms of even how they allocate the money. They've developed a very complex sort of fiscal regime that ensures that the money is not only spent for now, but it also has a future generation element to it. They ensure that the money is not all spent at once, which is, again, a huge risk, that as soon as you get all this money, then again, you just start going on a spending spree. So Ghana would be a country that I'd feel that Kenya needs to look at more closely.
Now, before we actually wind up this conversation, then, in your opinion, sir, from a person who sits within the value chain, what then can government do to ensure that fuel prices come down?
Yes, I mean, government, first of all, has to relook at the levies that are put on fuel. And then what we need also from the regulator is actually an analysis of the impact of this increment. For example, on the transport sector, on the food sector, because again, food is dependent on transport. And so government, ideally what government needs to do is just sort of lower the levies and fuel. And I think that's a role of Parliament. And we will be looking to petition Parliament to actually lower these levies on fuel.
So, in conclusion, this conversation has been around the viability, of crude oil production in Kenya. There's been a shift to renewable energy, but as you've said, the market is highly driven, by diesel-consuming industries per se. Futuristically, looking into long term, will this crude oil production come to fruition given our current scenario?
I believe it will. We have a resource, and so we need to use a resource before it again becomes obsolete. What you have to remember is also that crude oil does not only provide fuel, it also provides things like petrochemicals, including plastics and that kind of thing. So, I mean, it's still a resource that we'll need to use, but we have to have one eye on the energy transition. So if we are able to get the resource out now, we'll be able to invest in more renewable energy for the future. So our future lies in renewable energy, but we have a resource now that we need to use.
Our future lies on renewable energy, but we have a resource that we need to optimally utilize in good time before it becomes obsolete. These are sentiments shared by our guest this evening. That is the coordinator of the Kenya Civil Society Platform on Oil and Gas, none other than Charles Wanguhu. Thank you very much for giving us your time and ear to just learn about matters, the black gold as we refer to it. You're watching Business Insight.